Hey guys, welcome back to another stream. So, just changed locations for now, but I'm gonna try to go over a few more flashcards for maybe the next 30 minutes to an hour. Then maybe might watch the StatQuest video on Transformers. But let's just kind of continue where we left off here. So, this is going back to the convolutional neural networks. What's the common operation used when we apply the filter kernel onto an image? I think the operation here is the dot product. It's the elements. I called it the cross correlation earlier. I feel like those two maybe are very similar, but big idea, you're taking element by element multiplication, summing up all of those together, and then you get a final scalar value. Okay, so I'd say it's pretty good. What is the idea of padding? What is zero padding? And what does zero padding ensure? Okay, padding, really all it is, you're just adding more pixels to an image. Zero padding, I think what it does, it takes the center of your filter and then applies that center to all pixels of the image itself. And so what does it ensure? It ensures that your input is going to be the same exact dimension as your feature map, which is your output. So in this case, the center here is going to be this image. Okay. Right, so you have center, center. Okay, that makes sense. Okay. What problem does a recurrent neural network solve? Give an example and contrast this with standard multi-layer perceptrons and convolutional neural networks. Okay, so the recurrent neural network, it tries to solve the problem of different sized inputs and also maybe learning from previous inputs. So when you have time series data, example of this I think is stock prices. So this is an example that StatQuest gave when he was trying to use yesterday's and the day before yesterday's price in order to try to make a prediction about today's or tomorrow's price. And then contrasted with standard multi-layer perceptrons, convolutional neural networks, these neural networks kind of have a fixed sized input. So you're going to have to pre-process your data in order to actually fit the number of input nodes or the actual input dimension of a convolutional neural network. Okay. Take in a single input. Yeah. Main idea, long short-term memory. Main idea is you want to try to prevent the vanishing of gradients or explosion of gradients. But you do that, long-term memory. Okay. I guess I also missed the short-term memory part and also describing it. So, let's see. Long-term memory, the most recent output from the last recurrent, short-term memory, the most recent output from the last recurrent layer. And then the long-term memory is the outputs of activations from previous inputs in a recurrent neural network before they were rolled into the next. Outputs of activations for previous inputs in an RNN before they're rolled into the next network. Okay. Explain what the relationship between these two photos are. Okay, these two photos, they are describing the same thing actually, just different ways to describe a recurrent neural network. Basically, the first one here, it's an raveled recurrent neural network, so pretty much the idea is that you have an input which represents maybe some time series data or a sequential data, and then you then multiply that input by some weights. You add that with the previous inputs, and then so you have the previous input. In this case, it's yesterday's stock price affecting today's stock price, and then you pass that into an activation function. So you would then either make a prediction, and you also feedback or pass in your activation back into kind of the next step or the next recurrence in your network. And a better way to visualize this is with this. So you can see that yesterday you have 0, pass that in here. Then you will pass the value of the activation into today's kind of recurrence, and then you do the computations, you add in yesterday's price, then you make the prediction, and then you can keep doing this recurrence over and over again until you have enough data or enough inputs in which you're happy about. Why I have that previous input yesterday by way W2 and input it today. The main point here is so that yesterday's price influenced today's price. Okay. How does the first stage of a long short-term memory neural unit work? First stage is called the forget gate. The forget gate, big idea. All it does is it determines how much of your input should actually, how much of your long-term memory should be used in the neural unit. And it depends on two things. So the input to the neural unit and then also short-term memory. You do some type of operations, usually some weight multiplication, and then you add the two outputs together, maybe some bias as well, pass that into a sigmoid function. Sigmoid function will give you an output between 0 and 1. That really represents a percentage of how much you should remember or pass in the long-term memory value to the actual neural unit. Okay, so long-term memory, percent of long-term to remember, short-term memory. Yeah, big idea. Okay, you have input, short-term memory, and then it gets multiplied together. Then you add them together, and then add some bias. Then you put this into the sigmoid, spits out a number. Then you multiply the long-term memory by the actual percentage. Okay. What is the exploding/vanishing gradient problem with RNNs? Basically, RNNs, they unravel. You have exponential growth in your values in your feedback loop, and that can cause really high numbers, really small numbers. Yeah. Say it's pretty easy. All right. Okay, two portions of the second stage of what are the two portions of the second stage in a LSTM neural unit? What is this commonly referred to? I think it's commonly referred to the input gate. And big idea, there's two portions. One portion represents the values that should be added to long-term memory, and then I think the second portion is how much of that value should actually be allocated. It's potential long-term memory, percent of potential long-term memory to add to long-term memory. Okay. Say that's hard. Simple naive ways to turn words into numbers. Simple naive way to turn words into numbers. Just putting them into a random number generator, randomly assigning. Problems, you could have similar words have completely different numbers, which causes the inputs into neural networks to do unfavorable behaviors, basically. Okay. What is an advantage of using a neural network to embed words instead of randomly assigning them to a number? Advantage of using neural networks to embed words instead of randomly assigning them to a number. I think a neural network allows you to learn context within a sentence, and then also big idea, you want to be able to learn better embeddings for your words. So it takes into the account of learning the position of the word and also how that might affect the meaning of the word itself and its relationship with other words in a sentence. I think maybe that's a better way of saying it. Okay. Okay. StatQuest uses the example of a sentence. Control 2 is great as a label that can help train a neural network to assign embeddings to individual word in the sentence with the goal of making predictions of the next word that appears when a word is input to the model. Okay. Okay, StatQuest uses the example of a sentence. A label that can help train to assign embeddings. Okay. Alright. I'd say that's good for now. Kind of shaky, but I think watching a video for the Transformers should help. I'm gonna say it's good for now. Okay. Better alternatives. Just creating a neural network to embed the words for you. And the goal of that neural network is to make predictions about the next word that appears based on the input word. And then the label is going to be a sentence that includes all of the words. Okay. Who are the main members of the management group? Who was their investment bank? So we had F. Ross Johnson, not chairman, but president CEO. Charles E. Hugel, chairman, and then Frank A. Horenberg, investment bank, Shearson, Lutton, Lehman, Sutton, Edward Horrigan. Okay. Edward Horrigan, EAH. Okay. Shearson, Lehman, Hutton. I see. Ooh, alright, so now we're getting into the statistical part of portfolio management. So, variance of x is equal to the expected value of x minus the expectation of x. Let me square that. So, how do we get from that to variance of x is equal to expectation of x squared minus expectation of x squared? Okay, so I think what we could do is first we'll take this term here, x minus expectation of x, we square that, so really what that means is you have these two terms, so this multiplied by the same thing. And then I think what we could do is then distribute these values. So we have x squared times x minus expectation of x times expectation of x squared minus x times expectation of x. So we have x squared minus 2 times x expectation of x plus expectation of x squared. Okay, so that's a lot. But then we have the idea of the linearity of expectations. Basically saying that if you were to add two random variables, then the expectation of that is exactly equal to the expectation of each of the individual random variables, and then the sum of those two expectations. So in this case, we have kind of the same idea here. We're just adding three different terms, and we're trying to find the expectation of the sum of that. So we could then distribute the expectation to every single term. So we have expectation of x squared minus the expectation of x times the it would be expectation of x squared minus the expectation of 2 times x times the expectation of x plus the expectation of x squared. So that's a shit ton of expectations. Okay. So I think another rule or concept we should know about is that the expectation of x can be treated as a constant. It's not a random variable. So when you have the expectation of x, really it's just the expectation of x. So I think then you have the expectation of x squared minus 2 times the expectation of x times the expectation of x. So then you have the expectation of x times the expectation of x. Expectation of x is a scalar, so it stays the same. Expectation of x just becomes, so that becomes minus 2 times the expectation of x squared. And then you add the expectation of x squared, so you have expectation of x squared minus expectation of x squared. Oh my god, okay. Yeah, it's really hard to describe with words because there is no way to differentiate between this and this. Maybe I could say parentheses, but big idea, two things to think about: linearity of expectations, and then also the expectation of an expectation. Alright, so this is what I was talking about. You expand it, and then you distribute the terms. Okay, and then this is where you get the polynomial. Linearity of expected values, okay. Yeah, so this is okay, so I think that's good. What is the main idea of long short-term memory? Okay, main idea of long short-term memory. Basically, you want to prevent vanishing gradients and exploding gradients. How do you do that? You have short-term memory, which I think takes in the output of the previous neural units in a network, and then also the long-term memory, which can kind of be thought of as a conveyor belt in which you have different neural units kind of passing along data or maybe removing data from the conveyor belt itself. previous inputs. No? Right, so you have multiple units. Yeah, this one's a hard one, so I'm gonna have to come back to this. Don't fully understand it, right? I'm gonna put good for now so I doesn't populate. First stage, LSTM neural unit forget gate work. Okay, so you have sigmoid, short-term memory, inputs, multiply inputs with weights, short-term memory with weights, add some bias, sum two together, sigmoid, multiply percent by long-term memory. Okay. Two portions, second stage of an LSTM neural unit, commonly referred to, I think, as the input gate. Two portions comprise of one, potential long-term memory, percent of potential, okay, first, potential long-term memory, second, percent of potential long-term memory, we should actually add to long-term memory. So, yeah, those two are the big ones. All right. Difference between gross debt, net debt. Gross debt, entire debt of the firm. Net debt, all the debts or gross debt minus cash. Okay, I'll take that. Now, should I do month or hard? I'll do hard. If the variables of a multivariable linear regressions are mostly uncorrelated, what is the relationship between the coefficients in a single variable regression compared to coefficients in the multivariable regression? So if a multivariable linear regression has mostly uncorrelated variables, I would assume that the coefficients would be similar because you don't have different regressors or variables. Capturing the maybe impact that the coefficient would have for a single variate regression. I'm gonna highlight this. Okay, that's good. What is the idea behind the cost of debt? Okay, cost of debt really refers to the idea of kind of the opportunity cost to debt financing. Another way of thinking about it is maybe the interest rate you would receive on borrowing as a company. So borrowing here could refer to borrowing from a bank, maybe through a line of credit or through a loan, or maybe even issuing bonds to kind of the general public. It's representing an opportunity cost. It's a rate at which we can discount cash flows of a firm. Usually it's incorporated into the weighted average cost of capital, just because when you try to value cash flows from a company, usually a company isn't 100% financed by debt. There's some equity involved there, and in order to capture kind of the cost of the debt financing, the cost of debt is a helpful tool to do that. I think one more thing to think about here is also the tax benefits. So when you have a loan, you're paying interest on that loan, and the interest actually is tax deductible, so it lowers your overall net income, and then you're able to save on taxes otherwise. So you always should maybe consider multiplying by 1 minus the tax rate whenever you're trying to use that as the post or after tax cost of debt. Okay, that was a long-winded answer for just this 2 simple bullet point. It's the rate at which a firm can borrow relatively long-term today, and this is also the required rate of return for bondholders of company. Okay. Who are the main members of the management group? Who's your investment bank? F. Ross Johnson, Charles E. Hugel, Edward A. Horgan, VP and CEO of RJR Reynolds, and then Shearson, Lehman, Hudson. Okay. Yeah, here's our boy Ross Johnson, by the way. Seems kind of chill. Okay, so in this diagram, what are the undervalued assets and what are the overvalued assets? Note that the diagram shows the security market line, which represents the feasible portfolios within market portfolio and the risk-free rate. Okay. This red line here is the security market line, and then you have the expected returns on the y-axis and then the betas on the x-axis. So usually what's happening here is if you have a higher beta, you would expect there to be a higher expected return if you're maybe a CAPM purist. But big idea here, more risk equals higher return. So you have these companies where they have a higher expected return for a lower beta. So what that means, I would think that these guys are going to be undervalued. So they have a higher expected return compared to the kind of expected return based on the security market line. Another way of saying that could be these guys are earning a higher return for their respective amount of risk compared to the amount that you would expect to return for that risk. So I think some big ones to think about here are Nike and Walmart. So McDonald's here is a lower beta stock and also has an expected return that's lower than what the security market line says. So what this probably means is that the price of McDonald's right now is too high for you to generate a high enough expected return. And so in order to push this stock onto the line, you would have to sell this, and then in order to push this towards the line, you need to buy it. It's a big idea. Oh, Tiffany here. All right. Okay, I'm going to add one more. So if the stock is undervalued, investors will buy it to push the price up, then move the stock closer to the security market line. If the stock is overvalued, investors will sell it to move the price down, which will cause the expected returns to fall. Expected returns to increase. And push the stock upwards. Pushing it closer to the security market line. Which decreases the expected return on the asset. pushing it closer to the security market line. Okay, so users will sell it to move the price down. Okay. Yeah, I think really this only applies to if you think about maybe the returns of a stock being comprised of its beta and the market portfolio. I think in practice, this is kind of a more unfeasible way to think about stock returns. But maybe in theory, it's a more simplistic model. I think the idea itself probably extends to different types of models, where this line here represents. This line here could represent different types of allocation lines, or maybe the benchmark portfolio, or some type of benchmark or signal, and then anything that's above that signal you could buy, anything that's below that signal you could sell. All right. How can we test the correlation between different dependent variables? Okay, so I would be honest, I honestly have no clue. So this question is asking, how can we test the correlation between different independent or different dependent variables in a multivariable regression? I'm not entirely sure what I mean by dependent variables. I made this a while ago. Maybe I meant independent here, but dependent variables are kind of the outputs of the multivariable regression. Maybe that's what I'm talking about, but testing the correlation. Could you maybe measure correlation between the regressors? Or maybe even you just run your regression multiple times, get a bunch of outputs, and then just test the correlation between this. I mean, I would think that all of them are somewhat correlated with each other if you have a line that goes up or down, unless you have a very flat line. Yeah, I'm not too sure actually. Okay, compute the covariance of correlation matrix. Alright, I guess it's simple enough. I'm pretty sure I meant independent variables here, so I'm gonna put this again. So, hint, it's not that this question is not asking for some crazy answer. Okay. Linearity of expectations. What are its properties? What is an example? Okay. Linearity of expectations. Big idea. You can take the sum of some constant times the output of a function, and then also a weight that's, I think mathematically it'd be sum of c times f of x. times x plus I have a double summation or maybe a triple summation. Let's see. Simply the sum of the expectations. Okay. Okay, so yeah, this is something I do need to try to remember. The expectation of the sum of c, some constant times a function of x. X is a random variable. It's just equal to the sum of the individual expectations. Okay. Yeah, there is no really x in the form of a scalar, but more so an x in the form of a random variable. Yeah, I check something real quick. Alright, let's go. Okay, I'm gonna come back real quick. Gonna use the bathroom, get some water. But I just saw that the performance stage that I'm gonna have to do this Saturday isn't gonna be carpeted. Hopefully. That means it'll be smooth and can do some cool footwork, but we'll see. Okay, I'm gonna do this again. Okay, I'll have this final question and then I'll head out for like 2 minutes. For any constant c, what is the expectation of c? Why? It's just c. The reason is because constant c doesn't change, so it has a 100% probability of happening. Okay. Yeah, I'll be back in a sec. Okay, made it back. Took a little detour around campus, but it's a nice day, so I thought I might just walk around for a little bit. Let's see. Alright. Next up, I think this is talking about some basic stats for portfolio management. It's asking what is cross-sectional analysis and how does it compare to time series analysis? Okay, I think the thing to think about here is there's just really two different ways to look at data. Cross-sectional refers to looking at data at one point in time across different observations. Maybe a good example in terms of stocks is you pick a single date, let's say January or December 31st, 2023, and you just look at a bunch of statistics here. It could be revenue or maybe operating income, net income, some ratios like debt to equity, operating margins, inventory turnover. So you're looking at a bunch of different metrics for a bunch of different companies at a single point in time. Time series analysis, you're really looking at maybe a single metric over time. So pick a single one, revenue, for a single company, Nike. Then you just take a look at the revenue for the past, let's say, 20 years. Okay, yeah, it's good. So one at a time rather than time series. How can we test the correlation between different independent variables in a multivariable regression? I think all you really have to do is just compute correlation or covariance matrix. Okay, that's good. What is the linearity of expectations? What are its properties? What is an example? Linearity of expectation, all it is, it's a property of expected values. Big idea, expected value of the sum of some constant c times the function of a random variable x is exactly equal to the sum of constant times the expectation of a random variable. Okay, so with that being said, I think a good example is if you were to take the expectation of, say, c times x plus b times y, it's just going to be equal to the expectation of bx plus expectation of cy. Okay, I'll take that. For any constant c in arbitrary function g, what is the expectation? C times g of x. It's just c times expectation of g of x. I think because of the fact you're just scaling it by some constant c, it's just a scaling factor, so. This I'm not entirely sure. I'll take a look. So, how to, well, let me think about this. Because c is just scaling this function. Yeah. Scaling this function, and if you were to say the expectation, it will be c think this is really because of, let's say, g of cx is equal to c times g c dots g of x. I think this is the big idea, right? Because this constant is the same as scaling a random variable within our function, or also just scaling the output of our function. Yeah. I think I'll do red. Okay. Okay, what is the idea of net working capital? How does Professor Lee define it mathematically? Net working capital, big idea. It's the amount of capital you have tied up in your company. The capital tied up in your company to run the day-to-day operations. Okay, so how does Professor Lee define it mathematically? It's comprised of current liabilities and current assets. Really just current assets minus current liabilities. He includes cash actually, so you have cash, accounts receivable, inventories. You add all of that together, then you subtract accounts payable. That usually gives you a good estimate of net working capital. But let's try to break it down a bit even further. So you have, in this case, cash, inventory, accounts receivable, subtracting accounts payable. I'm trying to think here. Maybe if we describe each of these, you kind of have this net receivables where you have accounts receivable minus accounts payable. That's how much you have. I think maybe that can be thought of as how much you're receiving from customers. Inventory is inventory that's tied up to the firm. So these are goods that you're going to sell. And then also cash. This is cash that you could use for honestly any purpose you want. You know, in more traditional net working capital measurements, I think non-cash working capital is a more practical use. It makes more sense to me just because cash you could use for whatever you want. Doesn't necessarily have to be for the day-to-day operations of the business. And so when I think of net working capital, I really think of capital that's actually tied up in the operations, not necessarily cash that's free to use for whatever. Yeah, that's why thinking about this a little bit kind of hard, but I would say that's the best explanation or theory that I have. Okay. What is p-value? What is a high or low p-value mean? Okay, p-value is a kind of acronym for probability value. P-value really, it's a measurement of the probability that your alternative hypothesis happens, assuming or given that the null hypothesis is true. So this is a common measurement in statistical testing when you're testing between a null or an alternative hypothesis. And to maybe break that down even further, null hypothesis usually is the idea that when you're running an experiment, you have either a relationship between certain variables or there is no relationship. Usually your no relationship is going to be your null. Your alternative hypothesis is there is going to be a relationship between these different variables. And so if you have a very low p-value, that means that the relationship that you're observing has a really, really, really small chance of happening, given that there actually is no relationship. Basically, another way of saying this is that there's a really small chance that the variables you're observing and the coefficients associated with those variables just happens by random chance. Okay, maybe another way of saying it's very difficult to observe those values. There's a very unlikely chance that you're observing these values given that there is no relationship. Or maybe it's very difficult to observe the realized values given that all of them are random. Maybe that's the best way to put it. So p-value is a measure of how likely you're observing these values and the relationship between these values, given that all of these values are just random and that there is no relationship. So high means that you have a good chance that this happens randomly. The values that you chose happen randomly. The values in your sample are just randomly associated with each other. Okay, I think it'll be better to have a grounded example to describe this. Yeah. Maybe I have to watch a few StatQuest videos here, but I'm gonna put this as hard because I don't think I have a super strong grasp of the p-value stuff. No hypothesis. This goes to hypothesis testing. Basically, the idea that your data doesn't really have any observable relationship. It's kind of like your ground truth. I wouldn't say ground truth, but more so base case. Base case in the sense that, let's say you're having some type of continuous data sets. The mean of that data is going to be 0, or if you have some type of discrete data, maybe the idea that there is no relationship between height or weight. Okay, there's no effect on the dependent. Right. What is a simple way to estimate the market value of debt? I think one way we talked about this in class was we could take all of the debt outstanding on the balance sheet and then take the interest payments on, the recent quarter, compute kind of a coupon rates, and then use that to, get a coupon rate, and then also take the weighted average time until maturity. So we have two things, coupon rates and then the weighted average time until maturity. And then the last thing we really need in order to price a bond is the discount rate. So this could be kind of like the yield to maturity, or maybe the market yield on a 10-year note or 15-year, 20-year note. Maybe even something that resembles the maturity of our bond, plus some type of spread for the riskiness of the company, maybe a credit spread. So we have these three things we could just estimate directly from the balance sheet, and then that's really all the things we need. Okay, maybe the last thing we really need is a principal payment, but then we can kind of price a bond that way just using an annuity, and then also using the annuity factor and also the discount factor for the annuity and also the principal repayment. Okay, so yeah, I guess we don't really need the interest rate. We just need the interest expense. Pre-tax cost of debt to value the present value of the bond. All right. Okay. Why do we want to use the pre-tax cost of debt, right? Oh, I think the reason is because in this case, you're thinking about as the bondholder, you're receiving these coupon payments. You're actually generating income from this. It's not something you have to pay out. So there really is no tax benefit here. So why? Because the bond is the perspective of the bondholder who is earning income from the bond, so she does not get any tax benefits. Discount rate should we use pre-tax or after tax? Okay. Cross-sectional analysis versus time series. Cross-sectional, look at single point in time across multiple observations. Time series, look at multiple points in time, maybe across multiple or single observations. For any constant c and arbitrary function g, what is the expectation of c times the function of x, y? So when we have expectation of c times g of x, it's just equal to the c times expectation of g of x. Y, I think the big idea here is that the c itself is just a constant, so you have the property where g of c times x is equal to c times g of x. It just scales your random variable, and same thing here with the expectation, it just scales the expectation. Maybe also to expectation of c is just equal to c, right? Okay. So rating agencies, referring to credit rating agencies, rate firms based on their kind of credit risk. Credit risk really is the idea of, are they able to pay back the debts, the loans, the debts that they owe? The main way they go about doing this is using the interest coverage ratio. So that's the idea of taking their operating income and dividing it by their interest expense. So this is kind of a measure of how much are they earning compared to how much they have to pay in terms of interest. If it's really high, that's really good. That means the company is earning a lot of money relative to the interest payments that they have to pay. So a lot of their earnings can be reinvested or paid out to shareholders, while if it's really low, then most of the operating income is going towards debt servicing payments, which probably is going to result in pretty poor performance in the future, and also risk of default. Oh, financial ratios, okay. Yeah, okay. Okay, so what is R squared? What is another name for R squared? R squared refers to a measure of how well a statistical model fits some type of sample or observable data. I think another name for R squared is the coefficient of determination. Alright, so fancy statistics way of saying this is a statistical measure of how well an independent variable or a collection of independent variables describes the variance of a dependent variable. Describes the variance of a dependent variable. So how much they're able to describe. The variance really is the spread between the mean. Okay. Another way of saying this is how well a statistical model is able to fit the distribution. Okay. I will put this as hard for now. What is the idea of a factor loading and factor investing? All that is, it's the coefficient associated with the factor when you're trying to run a regression based on the returns. Sensitivity returns to the factor Fi. Explain this graph. What anomaly does this figure show? Okay, so let's take a look here. Title is average portfolio excess returns and average beta estimates. We have excess returns and also beta on the x and y axis. Okay. So we can see here that this line represents I would think the capital asset pricing model, aka security market line. It's the returns of the market portfolio in excess of the risk-free rate. Now, one thing to note here is that this line is increasing, meaning that as you increase the beta of your stock or your portfolio, that should mean you have a higher excess return. The theory behind this is that you have higher risk, so you have higher return. But this graph shows that turns out companies with or portfolios with lower betas, aka lower risk, actually have the same or even higher returns compared to higher beta portfolios. And so that kind of shows that there is this low beta anomaly where companies or portfolios with lower betas actually tend to perform better than companies and portfolios with higher betas. Okay. That low beta risk companies tend to have higher risk-adjusted returns compared to high beta risk. Not even higher risk-adjusted returns. Returns. Yeah, I don't even think it's risk-adjusted. This just shows that they have high returns, period. So that's interesting. Okay, so I think this is probably going to be the last flashcard I do before I end the stream here. And going back to the idea of p-value, statistical measure when hypothesis testing. What it does, it measures the chance that you're observing the chance that the observable data is happening through random chance. Or maybe another way of putting that is chance of observing the data assuming that the null hypothesis is true. Basically, there is no relationship between any of the independent and dependent variables. Now, high p-value means that there is a really big chance that you actually observe this data through some random process. Low p-value means that there's a really small chance that this happens randomly, so there actually could be a relationship between the variables. Okay, yeah, I'll take that. I'll take that. What does a convnet learn? All right, I'll just answer this too. So convnet learns a filter. So these are the kernels that get applied for each convolutional layer, and all it does is it takes the dot product between, let's say, a 3x3 area and a 3x3 area of the image or the input. So it just learns the weights on that filter. Which gets put in. Okay. Just results in a feature map n by m. Okay, I'm gonna flag this orange. So I'm not entirely sure what I mean by n by m inputs. Okay, I guess n by m, where n is the number of rows, m is the number of columns, right? And then our filter itself is going to be n by m as well, 5 by 5, and then n by n by k. Okay, so the filters themselves are n by m by, we'll call this c, where c is the number of channels. Right. I think when you have a matrix or tensor multiplication in higher dimensions, it gets really confusing for me to visualize. So I'm going to probably have to come back to this in the next stream and see if I can figure out how the fuck that works. Maybe, so how to think about tensor multiplication. I'm not too sure what isomorphic means, to be honest. Yeah, maybe a helpful. Okay, what does isomorphic mean in linear algebra? Same. If there exist linear maps A, V to W, okay. YouTube, let's see. There's tensor products. Okay, maybe I'll watch one of these. Ooh, maybe this one. So this actually might be helpful for StatQuest. Okay, so I'll end the stream here. I'm gonna go get some lunch right now before class starts. So thanks for tuning into the stream. I feel like these 2 flashcard sessions did help refresh my memory a lot about certain topics, and I think I have exams maybe in 2-3 weeks, so I think I'm gonna have to lock in a little bit and really start intelligence maxing for the next 3 weeks. So hopefully I'll be consistent with this and see you guys in the next one. So peace.